Hello, everybody. Good morning, good afternoon for everyone who are watching this. So my name is Derek Zhang and representing Group 4 for the second presentation. So today I will be presenting on the recent interest rate cut, of course, by the Bank of Canada that occurred on July 24th, 2024. So last Wednesday. So this presentation is based on a Bloomberg article that provides an in-depth analysis of this cut. So about this article, on July 24th, the Bank of Canada announced a second consecutive interest rate cut by 0.25% after the first one in June 5th, bringing the benchmark overnight rate to 4.5%. So this decision was driven by concern over weak household spending, like consumption, and economy headwinds, as well as the progress towards controlling the inflation. Of course, the inflation need to be controlled, which has the declared rate to 2.7%. It's quite high, but it's better right now. So the rate cut led to a rally in bonds in contract, with the two-year Canadian benchmark yield dropping to its lowest since May 2023. The central bank aimed to maintain the inflation target of 2% while addressing economy risks, including the potential impact of upcoming mortgage renewals on household spending. Officially suggest that further rate cuts are possibly in future meeting. Of course, in the meeting of August and maybe in September, with the overnight rate expect to reach 3.75% by December 2024. So this presentation will cover four parts. The Bank of Canada rate cut and the market recession, the market reaction and the term structure of interest rate and the mortgage and real estate market. So the class content will be related. At the same time, you will get a deeper impression about the article as well in the following PowerPoint. Why is the interest rate will be cut in this particular time at 2024? Since you can see the graphs since 2022, the interest rate start to climbing up. So as we know in the class or in the real life, that the pandemic have the key impact on interest rate that make Bank of Canada have to decide to raise the interest rate. So the pandemic is starting from 2020 and ending in 2023. So maybe now is a good time to cut because economy is start to recession and the economy is start to rehealing and everything is going to be better. So based on the cut, we can see that on June 5th, it is the first cut since a long time, since about just right before 2020. So on June 5th, it cuts also 0.25%, which bring the interest rate to 4.75%. And on July 24th, it start again, which bring even further to 4.5%. So when the interest rate related with inflation, you can see very interesting thing that also the question why to raise or cut the interest rate right now and at this particular moment. As you can see in 2020, the inflation started to going down. Why is that? Because also you can see on the right, just before 2022, the Bank of Canada decided to raise the interest rate. So which means that, okay, the interest rate raise in a special moment, of course, especially the pandemic, it will do some effect of the inflation to control the inflation to 2%, the 2% target. So come to the bond market. On the left, you can see the graph about a 2-year government bond and over 10-year government bond yield comparison. So by looking at the tail of the line, you can see that the 2-year Canadian benchmark yield dropped to the lowest since May 2023 at 3.62%. Of course, this does affect by the drop of the interest rate. It directly affect the bond market. At the same time, the article also mentioned that the Canadian dollar fell to 1.38 Canadian dollar per US dollar. So what does these two take us as conclusion, as a expectation? Uh, so the first, as the bond market yield drop, reflects that the investor expect that it will continue the rate cut and the economy will continue to be slowed down. At the same time, as the exchange rate drop, the domestic currency devaluate, and the capital inflow to domestic increase export and decrease import, because buying Canadian good is much cheaper than buying other countries' good. The three factor about the term structure of interest that we recently learned in the class. So you can also see the same graph on the left about the 2-year and over 10-year bond yield. And you can see that it confirmed the factor 1 and factor 2, which first one, which is interest rate on bond of different maturity, always move together. As you can see, after January 2022, it pretty much going up and going down altogether, no matter it's short term or long term, it moved together. At the same time, you can also see that if the short term low, the long term will high, and the inverse will be the same, will be the same case. So as you can see, around the July 2022, there is a swap between short-term and long-term bond position. That before that is a short-term lower yield, and after that is short-term higher yield. But one thing it cannot be seen on the graph, which being rejected, is that the yield curve always sloping upward, which you can see starting the pandemic, nearly January 2022, the 2-year bond yield started going down, and it's a really depression market. So come to the expectation theory and the liquidity premium theory. The expectation theory explained the first factor and the second factor, because for the first factor, based on you see from the numerator, as the short term increase, the number increase, the long term I and T, of course, they will increase because it's a numerator. And the second one, if the short term long and the long term will be short, because if the short term is low, people will expect more yield on the long term. So come to the liquidity premium theory. It said that it always explained that the market will going up because the liquidity premium. And but why we add the word always? Because of pandemic, as you can see on the January 2020, the market is not like what we expect. And come to the last little point, impact on mortgage renewal. So upcoming mortgage renewal seen as a downside risk for household spending, and also lower rates as the interest rate become lower, and to reduce payment shock from home buyer with pandemic era loans. So if I am a mortgage taker, of course, if the interest rate drop, I will still consider to get a new mortgage instead of doing some consumption to spend my money elsewhere, because right now it's pretty much good deal compared with the pandemic time. So lastly, about the real estate market, the article mentioned that the sharp rise in housing price no longer as a main risk. At the same time, contribution of housing to the economy in 2024 expect to be lower, which means that housing market will not affect significantly to the market after 2024, will be expected that way. At the same time, the growth forecast revised down to 1.2% for 2024. However, as the interest rate drop, of course, in the future time, there will be a big chance that the real estate market will be growing up really high and growing up really fast because the interest rate drop and the cost of borrowing is dropping. All right, that's for my presentation, and thank you so much for listening. Hope you enjoyed it.